Good morning, welcome back. It has been a while since I've seen you guys. Hope you guys are doing good, and it is the pre-market rundown with the Everyday Growth Advisors. It has definitely been a little bit of time before I've been on YouTube, so forgive me if I'm rusty, but it's all about getting back on this horse. I have of course, as usual, the macro updates for you guys, and then a little bit of a TA breakdown. If you have any tickers that you want me to break down, go ahead and put it in the comments right now so I can do that later. I will be going through also the snipe list, which is part of our Discord. This is a free list of stocks that we're watching for the week, typically key levels in which sector rotational stocks or thematic stocks are being rotated into or out of. Setups that we really like. So let's get straight into it. So right before I left to get married and everything that has happened in the past, month and a half, we were pretty much approaching all-time highs somewhere around here. That was before my wedding in August. It was about a month back. So about the end of July, this is the period of time when we were talking about how the market would be facing some volatility in the short run. After which we had a sharp correction downward, which was mostly caused by earnings and also just a general lack of trust in the Federal Reserve, outlook on the economy, and also the rates or the bonds or yield curve being uninverted, which signals usually the start of a recession. Now, there's a lot to unpack today, so I would just kind of listen in and try to make sense of all the things that we're going to talk about. And then I'm also going to give you some practical approaches on how to kind of, circumvent all this price action and not get too crazy or get too confused on what the market's about to do in the next couple of weeks. Of course, the main focus of this session is to talk about CPI and FOMC, which is going to be next week on Wednesday, and then the week after. On the 18th is FOMC rate decision. Okay, so from a macro standpoint, we had a little bit of a correction. There was a little bit of panic selling, and then a very quick buy up from bulls, which then led to a rejection. And now this is the recent sell-off. And if anybody knows what is the reason for the sell-off, you can put it in the comments, because I, obviously love to hear from you guys. But in my opinion, there is a very big consensus in the market right now that is focused on understanding that, okay, the Fed rate cuts are here, and what's about to happen in the next couple of months. Now, the market is overall throwing a tantrum with regards to the decision, or rather the delayed decision of the Federal Reserve trying to cut interest rates a little too late. Now, because of this, the market has corrected downward again. And as you know, I like to keep saying the same thing. The market is like a very interesting, character. It's kind of like you driving down a road, and if you see, multiple traffic lights in a road, and one of them is red, the market is not going to push forward in a singular direction. But if you have all green lights, then the market's ready to move in that singular direction. Right now, we had CPI come down to levels acceptable by the Fed. We had jobs, which is come down to a acceptable level by the Feds. But then we had a little bit of unstable forward guidance coming out from some tech companies in this previous earnings season. Now, this has caused the market a little bit of anxiety. As you can see, the major difference in this recovery right here is how the NASDAQ failed to even come back up to retest the highs, but instead became weaker and corrected downward back to kind of retest the bottom level here at 18,400. So this little tantrum or this anxiety is being driven by the fact that the market is thinking, okay, well, the Fed might have taken a bit too long to make this decision. Now, is that right or wrong? Is irrelevant, completely irrelevant, okay? Because what happens historically during the month of September and October in election season or election year is that the market typically takes profits. And September is known for being a sector rebalance month, as well as October as we encroach into the new cycle. So a lot of hedge fund managers, portfolio managers, endowments, and whatnot, they often rebalance their portfolios in the month of September and October every year. Now, this is also a period in which there are lesser corporate buybacks. During this period from May all the way up to August, there was an immense amount of corporate buybacks. What does the corporate buybacks do? They prop the market up and provide a little bit of shielding liquidity so that if some sell-offs happen, portfolio managers are more ready to kind of buy the dip on their own stocks, right? Because they want to return money to shareholders. And what's the best way to do it than to get their own stocks at a discount, right? So we've been seeing a lot of that. And the major sectors that have been rotating in the past, couple of weeks, we've been seeing obviously commodities, gold kind of rallying as a hedge against the economy. We have been seeing, of course, oil as another commodity being very, very shaky. Now, more on oil on another day, because this is a topic that has to be covered on its own, in my opinion. But in the short run, I'm going to be slightly bearish on oil because of just supply constraints. And there is currently a little war. When I say war, I don't mean a literal war. I mean a price war between OPEC Plus and America, right? Because in case you guys don't know, America has now taken over as the leading oil producer in the entire world. And because of this, remember that the rest of the world always depends on America for technology relating to fracking, relating to oil discovery. They are kind of the people who have developed that technology to the largest degree. So right now, just to keep things very simple, I'm bearish oil in the short run because of just how supply is going to play out in the next couple of months. I would say 6 months or so. The sectors that have been rotated out is semiconductors. Now, this is a very obvious one. I think you guys have seen this. Semiconductors have gone through a big correction, and I mentioned this right before I left, that this sector is largely cyclical. When there is big demand for a specific, sector or product in a specific sector, then there will be a imbalance in the future. And so semiconductors is one of those sectors that is seeing that right now, with productions being ramped up by NVDA and AMD. But then in the long run, in the next 6 months, 8 months, they will be in oversupply mode because they would have released their H100 chips. And then they have their, what is it called? The Blackstone chips as well. I believe it's called Blackstone or something, Blackwell, Blackstone, something along those lines. And when they release those, they say they're already outstripping demand. So very likely that NVIDIA might end up overproducing some of the chips and other chip makers might do the same, right? So semiconductors as a whole is being priced in right now for that oversupply. And, you know, long run, if you're an investor in semiconductors, you don't really need to worry so much about this, right? It's just one of those things you got to understand. You get a discount scenario, you can average in on your favorite stocks. So let's look at a very interesting thing about how earnings have been performing. So I posted this on our Discord. Once again, if you're not a part of our Discord, you should highly consider being a part of the free members. It's free to join. You can click on the link in the description below on this video, and you will find it right there. So you can see the earnings revisions have been very concentrated. The 2024 net income, have a look at this, right? It's pretty crazy. So the S&P 500 is going to be the blue line here. The Mag 7 is your orange or yellow line. And then you have the rest of the S&P 500 and Mag 7. Now, you realize that the majority of S&P 500 stocks are very narrowly underperforming the market. However, when you take into account the Mag 7 X NVIDIA, right, the narrow gap that occurs is even larger. And then when you just take into account Mag 7, the difference is almost 30%. In terms of net income. That means that the Mag 7 is literally propping up 30% of earnings for the stock market. Now, for those of you that don't understand this, the top 7 companies are essentially carrying 30% of earnings for the S&P 500 right now in a rough sense. Okay, now not exactly 30%, but roughly there, right? And then if you look at the percentage market cap versus the percentage net income, the top 5 companies in the S&P 500 share of total, you see that the gap is even wider, which means that the top companies are outperforming by a wide margin, right? And then if you look at that from the AI related stocks on how they have performed and pulled back in the recent weeks, you can see that the AI boom, which we had seen all the way in this year, since almost actually, you know, January or February, looks like it's kind of correcting downward now and looking for a bottom again. So this kind of just shows you where, in terms of the breadth of the market, is everything. And I feel this is a really important factor because when you're talking about how the market's performing, you need to know what is performing good and what is performing bad, right? So all in all, let's have a look at some of these Mag 7 right now. Okay, so NVIDIA, first of all, okay, just to give you guys a little glimpse. Now, especially if there's people here who are just focused on long-term investing and you're, you know, thinking to yourself, hey, what's a good spot to buy NVIDIA? Well, I've done the work for you, okay? Here's a little guidance on where are good spots in which you can allocate some capital into NVIDIA. So the first allocation would be at $99. We are kind of around there. So I wouldn't try to time this. If you're around here, I would advise, if you don't own NVIDIA stock, this is a good spot. If you want to buy chunks of 100 shares and you don't mind putting down that much of money, then this is an area where you can sell some cash secured puts, right? Not saying that NVIDIA can go further down, but your idea is when you sell those puts, you get a premium and then you get a discount on the shares anyway, right? And puts would be pretty expensive here. The second level which you can buy NVIDIA is $86 or so. And the third would be about $76. Now, this is not part of the snipe list, but these are just long-term investment picks that I feel everyone should be picking up right now on these dips. The Mag 7 indeed are good things to add to your portfolio. Now, what about Google, right? Google is a good spot once again right here to add an initial tranche. If you don't own Google, this is a good spot. You can sell cash secure puts, or if you don't have money to buy 100 shares at a time, then go buy a couple of shares, right? The second best spot will be at 125 and the third will be at 105. Now, I know these seem very far, but remember that I've seen the market do some wild things. This doesn't mean that I'm aiming for these points. It just means that if Google comes down to 149, I obviously, for me personally, I wouldn't add it here because I already have some at this price or lower. But the next spot would be at 125 is where I would average down, and then 105 would be the next level where I would average down. And Amazon, the next one. For Amazon, I would go to add a little bunch of first tranche here, a second tranche at 145, 146, and then a third tranche at 120. Now, remember, this doesn't mean that I'm aiming for these targets or anything in that way. All I mean is, if you're a long-term investor, you should be looking for these points to add long-term shares, because if the stock drops this much, then you should be prepared with dry powder to buy them. So T, what happens if Amazon just bounces here, right, and goes up? Well, add your tranche here, then don't add anymore, because these numbers that I've chosen as allocation points for all these stocks is based on the intrinsic values of the shares, right? It's based on my own calculations, based on how much I think the shares are worth in terms of their cash flow and their future cash flows, right? What about Microsoft? So Microsoft is another one. It's come down pretty fair bit. You know, this is the leader in AI. They own 50% of OpenAI as well. Not a bad stock to own long term, but I would buy some only at 389 as a first tranche, 344, 345 as a second tranche, and then ultimately at 280 for the third tranche. Now, obviously, not saying that Microsoft's going to get that low, but if you get down to here, you buy some. If you don't get down to here, you just hold cash. You wait and you wait and you wait, right? And if the valuations start to increase, then we do a revaluation. Okay, that's how these things work when you're a long-term investor. You have to know what the value is of things. So that's kind of where we are with Mag 7. Now, what about small caps? Small caps also have retraced quite a fair bit. This was one of the darling Charles of the stock market recently, because everyone was, kind of pushing small caps into the radar. Now I think that has become a pain trade in the short run, because a lot of these trades are oversaturated. However, this is not a bad spot for those of you that don't have exposure on IWM, right? You can add a first tranche here, sell cash secure puts. If you have roughly $20,700 sitting around, maybe you could sell some 205 puts. And then, you know, if you get a sign, you get a sign, and you'll get a discount on them anyway. So you probably get them closer to $200 or so, right? And then moving on to the 10-year yield, right? This, remember, it largely drives equity prices, drives borrowing and spending, drives the Fed lending as well, control money supply, etc., yada, yada, yada. You get the point, right? Broken down into a downtrend, continues to be in a downtrend. And if it holds at the 3.6 level, then it'll probably move higher to retest some of these higher levels. But if not, then it's going to go further down, which is then going to be bullish for stocks further, right? So this will be largely driven by the CPI and FOMC, which is coming up in the week ahead. And then you have the dollar index, which is firmly sitting in a demand zone here. The dollar has done very fairly in this area. It doesn't mean that we have to bounce here, but of course, there's a higher likelihood that we bounce in here. And if the dollar does bounce up here, then it's going to send a mixed signal for stocks, because that will put pressure downward on the equities, right? Now, VIX has been going kind of crazy lately. A lot of volume unclenching, a lot of gamma rolling from dealers. There's a lot of activity here that is just very messy. And I'm going to tell you guys very straightforward that I anticipate that this messiness, this pullback and sideways movement, or this little whatever movement that the market's going through right now, is going to go on for at least a couple weeks more. I would say until the Fed doesn't make a decision, which the Fed is kind of largely deciding between a 25 basis rate point cut and a 50 basis rate point cut. But until and unless the decision is not made and is favorable for the market, which means AKA 50 basis point cut, then it's likely to throw a fit and say that the Fed is not doing its job correctly. Okay. Now, having said all of that, of course, let's have a look at what the market is pricing in, right? So you can pull this up on the Discord as well. Once again, our bot allows you to pull all of this information up by using the command econ Fed rates, and you can see the chances of the Fed rate cut. So immediately in the September 18th FOMC meeting, you can see that the market's pricing in a 70% chance of a 25 basis point rate cut, right? And you can see that existing interest rates are currently sitting around, let's see, I think it's 5.33%, if I remember correctly. Yeah, it's 5.33%. So the market's pricing in the chance that we go down to 5 to 5.25, and then a 30% chance for a 50-point basis rate cut. Now in November, the market's tune kind of changes here. If we get down to 5.75, which is a 50% rate cut initially, then they price in a 25 basis point rate cut. So I think the likelihood scenario here would be a 25 basis point rate cut and then another 25 point basis rate cut. And this is what is causing the market to lose its shit right now, because the market's kind of expecting a 50 basis point rate cut, and it will throw a tantrum just like a little child, right? And at the same time, in December, you have a 4.0 to 4.25, so then another 25 basis point rate cut. And it's kind of neck and neck here. You guys can see it, right? Market's pricing in equal chance almost of a 25 basis point or a 50 basis point rate cut. And then thereafter it's just mixed, right? The January meeting one is mixed at this point. So as we get over the September, there will be revisions to the November, and then the December, and then the January. So as we get on and market conditions start to improve, then we'll see, these get revised. Now, it is worthy to note here that the US economy is still expanding. The US economy's GDP still got revised and was a little better than consensus. So it's not the economy is doing bad. It's just, certain underlying conditions of the economy that are being seriously scrutinized by the market. And that's okay, right? The market's going to do that. Speculation is part of it. But what's important is that we don't lose our shit and we don't lose our cool when things like that happen. So I fully anticipate that this month of September and October will be a little choppy. We might see sideways action. If we try to retest, we're going to try and retest 5,500 first. If we just go into the little bit of the TA here, the technical analysis, which, we can dive in further as well. A pullback here will likely lead us back into 5,500, which we got up on the potential bounce level. I posted this on Discord and IG, just last week, saying 5,400 is a pretty key level for us to bounce, which we did bounce off, which is nice. And now we'll be looking at 5,500 as a potential rejection area. So if we get a rejection area, then we likely come back down to test a lower level of liquidity, which is then going to be 5,300, and then 5,200, and then 5,080, roughly 5,090, which is around 5,100. Do I anticipate us to get down all the way down here? I don't think so. But a 61.8 bounce is highly possible, right? So from a technical perspective, I think this will be more than likely driven by the weak NASDAQ, which has been the main topic of discussion in this past 1.5 months. The NASDAQ here is going to have to do a slightly deeper run to the upside, which might cause some confusion for traders. And if we reject 19,550 with the rejection here, then that may lead for a double bottom or a further breakdown into 17,827 and then 17,457, which were two key levels prior that got bought up at. So that's going to be your main liquidity providers, these white zones right here. Now, let's go through the snipe list and see what are some opportunities this week. I've posted this on everywhere this week just so you guys can get a little idea on what we do on the Discord, right? So this week, we have a opportunity that I like to see on XOM. That's the first one, so let's have a look at that. XOM breaking down from a large pennant style breakdown, almost like a wedge, actually, not pennant, but a wedge. And as long as XOM rejects 113 or 114, then we can probably expect XOM to come down to 110. That will be a bearish leaning bias. However, if XOM bounces above 113 and finds a little bit of support here, then we are looking for a potential swing trade to the upside, but this has to be followed by a confirmation of higher highs and higher lows on a 15-minute time frame in what is called the two-wave confirmation, which is a signature EGA confirmation, right? It's not rocket science, and this is not something like a gimmick or anything, right? All I'm saying is if something's in a downtrend, that means it's making lower highs and lower lows, right? We all agree. But if something wants to reverse out of downtrend, it has to first form a channel, right? Like this. And then what happens is initially you get a breakout, right? And this breakout is what we call the first wave breakout, right? For those of you that don't understand trade structure and price action structure, this should be a nice little refresher for you, right? And once you get this first breakout, this is not your confirmation. It's always the second wave that you wait for and a pullback, confirming higher highs, confirming higher lows, and this is ideally your entry, right? Why is the first wave not your entry? The first wave is not your entry because this could be a fake breakout. So in order to validate the rules of liquidity, you need to see a consecutive higher low twice, and then you can take your entry. And that will lead to a higher high eventually. So that's get here with XOM if it breaks out. If it doesn't break out, what's going to happen? It's going to reject 113. And if it continues down that path, then we'll see lower highs, lower lows, and that will be slightly easier to trade. So just going off that, this is a pretty straightforward setup, and I hope that you guys will be following this one along with us. The next one is Caterpillar. Now, this one's been forming kind of a very large bull flag, but at the same time, if you look at this, just from the Fibonacci retracement standpoint, it has come very close to retracing to 50%. Now, whenever you have an extended impulse wave like this, and then followed by a 50% correction, it's typically invalid of a bull flag. So this is a daily bull flag. And the reason why that is so is because now bulls have lost momentum, or rather the trade setup is no longer bullish, but it's sideways or it's uncertain, right? So this setup here, the main primary thing that I like is we had kind of a double top scenario here, and then we've been making we put in a lower low, right? And then we went in to put a lower high. So this is showing us that, okay, maybe the structure is shifting a little bit, and we might see Caterpillar here reject 333 or bounce on 333. So you'll see for our instruction for Caterpillar on the snipe list, the idea is if you get a 333 bounce, then we want to aim to go for some 340 calls. And if you want to go for, if you get a 333 rejection, then you go for some 330 puts. So very simple, straightforward setup here that I like. And I think this one is, pretty good setup that has pretty good conviction. So the volume has been trading quite nice as well. Next is QCOM. This is one of the semiconductor names that have been getting absolutely demolished ever since making highs at 230. And you can see here, we're looking for a 161 bounce or a 158 rejection. So what does that mean? So you can see that QCOM is currently kind of waiting to see what happens at this level here, key level, right? So if we can bounce, where we are currently, is slightly above it, and start putting in, once again, a higher high scenario, then only would I be comfortable taking a bullish position. And I would only play that to 165. I don't want to play it all the way up to 168 because there's really no guarantee that this could go all the way up there. You're just playing a short-term bounce here at 161, and if you get that, at 158, even better, right, at the open. And what about the bearish trade? That's if you get rejected at 158, very straightforward, right? So where you are currently, if it moves further down, comes down like this, and then rejects, right? Then we're looking for a further downward descent, and that too at 155, which is just below it. Right, so these are short-term moves. I typically try to mix up the snipe list with swing trades and day trades so that everyone has a little piece of action. And then the fourth one, last one is Affirm, right? And Affirm is one of those that also have had a massive bull flag. And then the bull flag turned into a very long downtrend for almost a year. And now this peaked out, right? There was some really good earnings. But because of the environment that we're in right now, the market is more favoring value defensive stocks. So the market's kind of favoring your Coca-Cola, your consumer staples, right? Look at the sectors that are doing really well. Consumer staples, right? Utilities are doing really well. All the safer, like more predictable cash flow stocks, things that consumers would buy regardless of a recession. Now you must be wondering why this is happening. The reason is because the market is pricing in a recession right now. Because typically what happens after a rate cut is a recession. okay, and the economy slows down for a little bit, and then it takes off. That is historically, that's the way it's been. So very simple, direction for a firm here. If you get a 39 bounce, right, which is currently right above it. If you get a 39 bounce here, then you want to take some upside, and you can do that by taking upside into $40 calls. And if you get a 38.50 rejection, which is just below where we are right now, right, then you should go for some 36 puts, which is right below here, right? So once again, these three scenarios, QCOM and Affirm, these two are mostly going to be day trading scenarios. And then for XOM and Caterpillar, I like these more for swing trades. So the first two are going to be swing trades. The next two will be day trades. What does that mean in terms of what you have to choose for expiries and etc.? For these, you want to go at least for 50 to 80 days out. For these, you want to go at least 1 to 2 weeks out. Okay, so that's the setups that I'm looking for this week. I hope that this is helpful for you. Let me answer some of the questions now. Loving these election season ads. Oh, damn. Okay. And then, do you think bonds are a good buy right now before rates drop? Absolutely, right? You cannot time the market perfectly, right? So if you look at bonds, so primarily for bonds, what do you want to buy, right? There are primarily three things you can buy. The first thing you can buy that's the most sensitive is going to be TLT, which are your long duration bonds. You see how it says 20+ year treasury bonds? This is not, terrible to buy a first tranche share. See, I've already marked out where I need to buy my bond allocation. So I'm already allocated to bonds. I've been adding bonds as, ever since they were really this low at 88, at 86. I bought some more at 90, 92. I've been adding along the way to build a nice part of my portfolio that's going to be defensive, right? And these will do good in the next couple of years. So in terms of bonds, here's where you want to allocate. Now, I know this might seem a bit confusing. How can points be above? Why would you want to allocate above you? Well, because bonds are simply undervalued, right? In terms of how things are going to play out. Understand that when the Fed wants to go and perform quantitative easing, how do they do that? Does anybody remember? They have to buy bonds, right? They buy bonds, then cash comes out of the treasury account. So when the bonds come back in from the market and cash goes out, that's how money flows into the stock market. And that's how money flows into circulation, into the bond market and into the hands of regular people. So banks typically buy and sell bonds from the Fed. That's how money supply is circulated, okay? Then you have another option, which is TLH. Now, TLH is, once again, these are 10 to 20 year duration bonds. These are going to be the ones that will have a direct impact when the Fed announces that they're going to do quantitative easing, okay? And then the third, if you want to go for the most conservative one, is going to be BND. This is the total bond market ETF. Now, this one has got a very low expense ratio. It's 0.02%. So I would do this, obviously, if you're trying to decide on what bond ETF to go for. Personally, I have a mixture of all three. So pick one that you like or allocate into all of them. And just do so, intelligently. Don't do it all at once. Try to, cost average it out and wait for the time now. So to answer your question, Dylan, yes, it is opportunistic for you to get into bonds now because ideally you want to get in before the Fed decides that they are going to get in. And that's when you will see the bond market start to react as well. And yeah, that's all I have for you guys. I hope that you enjoyed the live stream. If you guys have missed it and you guys have missed these live streams, pre-market breakdowns, leave a comment below. Let me know if you missed it. And yeah, I love hearing from you guys. Definitely missed you guys. And I will see you guys back on Wednesday for another session. So have a great one. Take care and love you all. Peace and see you all. Bye.